In today's video, I'm gonna be covering the top 3 FHA loan mistakes to avoid. So if you're thinking about buying a house, make sure you pay attention and you watch to the end of this video so you don't make any of these mistakes like some of our clients have done in the past. And if we've never met before, my name is Sean Uehara. I'm a sales manager with Loan Depot, helping you finance your homes all across America. Whether you're thinking of purchasing, refinancing, buying your first house, buying multiple properties as an investor, or looking for that vacation home, we've got you covered. You can hit the description below. There's links to more information on how to get your mortgage right. Number 3, I'm gonna tell you a story about a client named Richard. Richard has been long since separated from his wife. However, he is still technically legally married. And with an FHA loan, if you are purchasing in a community property state, we have to account for your spouse's debt. What does that mean? So in Richard's case, when he was looking to purchase a home, we had to have pulled his wife's credit and qualify him for all of her debt as well. Even if she's not buying the house, even if she's not going on the loan, if you're buying in a community property state, the lender has to account for your spouse's debt. In Richard's case, he did not disclose that he's still married to her. He actually said that he was divorced. But as we were going through the process, we found out that he was still legally married, even though it's been years that they've been separated. In the 11th hour, I had to personally call his wife and explain to her what was going on. I had to get her permission to pull her credit, and we had to look at a couple of pieces of paperwork from her in order for this deal to close. So if you are still legally married, even though you've been separated for years, I would highly recommend you get legally divorced if you're going to be purchasing a home, utilizing FHA financing, and buying in a community property state. Number 2, I want to share with you a story about a client named Jeremy. Jeremy has been out of work due to COVID. Now with FHA, if you've been out of work for over 6 months, the guideline that they would like to see is that you've been back to work for 6 months. In Jeremy's case, he was let go from his job back in May of 2020. He was out of work for an entire year. And he recently went back to work May of 2021. He started at one job. He was there for a couple of months, went to another job, was there for 4 months. Then he got excited, wanted to buy a house. He went to a lender, got qualified, and actually got into contract on a house. Now, during the process of getting the loan approval, the underwriter had called out the fact that Jeremy was back to work for 6 months, but he was not back to work for 6 months at the same job. So the loan officer who was working on the file actually had misinterpreted the guidelines, thinking that as long as he's back to 6 months, that was good enough. But in actuality, they had missed the fact that he has to be at the same job for 6 months. So in Jeremy's case, he's gonna have to wait another 2 months to be able to purchase a home using FHA financing. So if you've been out of work for an extended period of time, make sure you disclose that to your lender up front. And again, if you're using FHA financing, make sure that you've been back to work in the same job for at least 6 months so you don't have any issues when getting your loan qualified. And number 1, I'll tell you a story about a client named Shane. Shane was actually looking to relocate to another part of the country, and he got qualified with a lender that was not familiar with the local county limits. And I say the county limits because FHA has a certain loan limit across the country, but the loan limit varies from county to county. So if you're working with a lender that's not familiar with the county limits, or if they're not familiar with FHA financing in general, I would strongly suggest working with somebody who does understand that. Because let's just say in a specific county, the loan limit is $420,000. If you were looking to buy a home that was, let's say, $500,000, unless you were putting a ton of money down, which it wouldn't make sense if you're using FHA financing, you would actually be above that FHA loan limit and you would have to look at conventional financing. Now, depending on your credit score and the rest of your file, you may or may not be able to qualify for that type of loan because FHA is a little more lenient when it comes to their debt to income ratios and their credit scores. In Shane's situation, his loan officer was not familiar with the county limits and actually qualified him for an FHA loan that was above the county limit that he was looking to purchase in. So again, if you are relocating, make sure that your lender is familiar with FHA guidelines and they are familiar with the loan limits. They don't necessarily need to be in that specific county. Myself, I'm licensed in 18 states, and we can help you all across the country, and we know how to look up and find the county limits in every state. So it's definitely not an issue. But make sure that they know the guidelines, make sure they know the county limits. Now, if you are thinking of purchasing or refinancing anywhere else across the country, comment below. We can certainly help you with your financing. And don't forget to check out this playlist on how to get your mortgage right, and I'll see you on the next video.